Hi, welcome to the show today. Listen, we're going to be talking about systematic risk. Now, that's just financial jargon that we use in our industry that says all ships basically rise and fall with the tide. Secondly, we're going to be talking about passive strategies versus active strategies, and then talk about what's called a buy and hold strategy, and does that work? And finally, we're going to talk about pension buyouts. You know, when do you take a lump sum or when do you take the annuity payout, right? There's reasons why you should and shouldn't. So stay tuned. We got an action-packed show for you today.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well. Plan to retire well.
All right, in this segment, I want to talk about what's called systematic risk. Now, this is just financial jargon, again, that we use in our industry, but basically it's the idea that all ships are rising and falling with the tide. Now, how can this happen? Well, let's say, for example, I own an index fund. Okay, and let's say this index fund is basically based on the S&P 500. Okay, so this index fund is going to basically move right along with the S&P 500 because that's what's in it. So the S&P 500, as it goes up and down, so is this index fund that's tied to the S&P 500. It's not going to be any different. Okay, think of a mutual fund, for example. Now, a mutual fund, let's say by objective, is holding large company stocks. Okay, that's all it holds. And let's say that the majority of these large company stocks are in the S&P 500. Well, for the most part, as the S&P 500 goes up and down, that stock mutual fund is going to be going up and down accordingly. Now, if the stocks it's holding are not completely the S&P 500, then it could do a little bit better, a little bit worse, depending on those ones that are included or excluded from the mutual fund. So, but you have to understand, for the most part, if its objective is to hold large company stocks, then for the most part, as ships rise and fall with the tide, that fund is gonna do the same thing. Now, in systematic risk, are there ways to avoid systematic risk? Well, one might be not have all your eggs in one basket. Modern portfolio theory says that if you well diversify and have a number of different baskets, now what might those baskets be? Maybe it's small company stocks, maybe you have a basket of mid-sized company stocks, maybe then you have the large company stocks, maybe you have a basket of bonds. Right? But if you were to well diversify that portfolio into a number of different asset classes, then would it not make sense that if the markets are rising and falling with tide, that maybe that might counter it? Right? That's basically modern portfolio theory. But what the problem with that is when 2008 comes along, as we found out, market dropped to half its value, there were very few asset classes that, held things up. They all pretty much went down. So what is it, what is it you're going to do to try to combat that? Well, one thing you might do is use what's called an active management. The idea that you're going to manage a portfolio so that when the markets are maybe not cooperating and going down, you can maybe adjust accordingly. This would be active management, saying, so if the economy slows down, now I'm going to make adjustments to make sure that I kind of maybe have something safe during those kind of times, or maybe don't have them in those asset classes that are going down. When you got a passive strategy and markets are cooperating, it's going to work all day long because the market's trending up. And that's kind of what we've had now here the last 10 years now, 6 months. Markets have continually trended up, and for the most part, most portfolios have trended up. But when markets start to go the other way, passive strategies are not going to protect you. You want what's called active management. You want the ability to be able to adjust accordingly to those market conditions. Now, one other financial jargon or tool you can use is what's called beta. You can look at a portfolio, and if it has a beta of 1, that means it moves exactly with the market. All right. If it has a beta less than 1, that means it's less risky. If it has a beta greater than 1, it means it's more riskier than the market. So that's something that you want to look at when you look at a portfolio in general. But folks, again, when markets have been going so well for so long, it's so easy for people to get complacent. They think they're set. They've said, yes, I've had some periods where the market has dropped and I've seen my portfolio drop. I've looked at my statement. It's a little bit down now, but I'm not going to react because I know it'll come back up. And that works all day long as markets are cooperating, right? And we just have minor corrections. But what if you get another 2000 through 2002 or another 2008 where markets are dropping to half their value and you're getting close to retirement? Folks, you can't weather that. So I say when times are good, as they may well be right now, this is the time to have a portfolio analysis. Come in and talk to us. Let us show you where you're at. Maybe we can even point out that beta you have right now and maybe you have some adjustments accordingly. So look forward to that. Thank you.
Well, Larry, thanks. That was a lot of interesting information there and a lot to process, but why would somebody that is in retirement or close to retirement care about that?
Jack, that's a great question. So much of those out you watching, you're a few years away from retirement or maybe just recently in retirement, and this is really important. This is stuff that you have to be paying attention to, especially right now. The markets have been favorable. We've had a nice run up in the market, and when we start talking about risk, people tend to want to close that off because they haven't seen it in a while. They've been fortunate their statements are going up and up, but boy, what a time when you're transitioning into retirement, into those years where, hey, you're used to getting a paycheck, but guess what? You're going to retire. Now you want your portfolio to generate a paycheck for you. So if we start talking about risk, if your portfolio is going down, how is that going to generate a consistent paycheck for you? So typically we'd like to see risk stabilize to some aspect and want to start working on income producing assets so you can live comfortably in retirement.
You talked a lot about the systematic risk and going with the tide up and down, and there's a lot of portfolios that are structured that way, but what would you do that might be different, or how would you address that?
Yeah, great question. I mean, we talk about all these index funds, mutual funds, right, and they make up a large part of the retail investments out there. So what would you do differently? I'm actually going to talk this a little bit more in detail in the next segment, but for the most part, what you want is active management. Passive accounts work well as long as the markets are trending up, as Art said, and then people don't need to pay attention. But when markets start to get volatile or maybe starting to head the other way, you want somebody at the helm changing it up, right? This is what we call active management. These are portfolio managers. They're going to actually react to market conditions and make adjustments accordingly. They're not going to just hold for the sake of holding when you shouldn't. So anyway, stay tuned because I am going to go into more detail about that in the next segment.
Today's retirement challenges can be mastered. Knowledge is power because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, financial advisors specializing in retirement planning, serving all of northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn highlights of the new Tax Reform Act, the difference between the fiduciary and suitability standard of care, how an IRA gets taxed to a surviving spouse, how two similar portfolios can end up with two drastically different results, what a bull market is and how long it can last, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Wednesday, September 18th or Thursday, September 26th at Boone's Long Lake Inn in Traverse City. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated financial decisions. Call 888-608-5825 today.
Hi, welcome back. Listen, today we're talking about when do you get out of the market. I talked in the last segment, about being in a bull market. Do I wanna stay and watch it drop to half its value? Maybe I'm not that person that wants to see that. Maybe I'm somebody that would just as soon get out when the time is right, right? Does really a buy and hold strategy work? Indeed, it will over the long haul. If I'm somebody that doesn't need to touch that money or touch my savings for income, and I've got plenty of time, to work with, maybe I'm that person and can ride it out. But maybe I'm that person that's near retirement or in retirement, and I can't see that kind of a fall. Then I'm going to want to get out, right? Today we have to recognize we don't want to find ourselves passively invested. If you're out there in an index fund, for example, let's say it's the S&P 500 index fund, okay? If the market drops to half its value, you're going to watch that index fund drop accordingly. There's nobody there in that index fund that's going to change it up to try to protect you. If you're in for example, a large cap mutual fund, right? By definition, that's a fund that's filed with SEC that it's going to hold large company stocks. That's what it's going to do. So if equities fall out of favor, stocks start to fall out of favor, and they're dropping to half their value, what is that large cap mutual fund manager going to do? By objective, they're going to hold equities. You would like to think that maybe they might be able to go to cash, right, to protect you for a period of time. And so, a lot of times if you look at the mutual funds, you look in the prospectus in that fine print, it literally says they can. But you will be hard-pressed to find a large cap mutual fund that actually did that when markets fell, because they don't make any money being in cash. So if you're in an index fund, you're in a mutual fund, a lot of times you'll find yourselves what you call very passively invested, because there's nobody at the helm doing anything to change things up. Now, what you might want to look at, what might be some alternatives, is what they call active management. Active management are portfolio managers that are actually reacting to market conditions. When fundamentals don't support the price of the market and they do need to make some adjustments accordingly, these are managers that are gonna make the adjustments accordingly. That's what most people who don't want to see big market fluctuations need. When markets are cooperating, of course passive investments are going to do fine. But when markets are not cooperating, active management is the key. Now, we have some challenges facing us today which make active management even more attractive or necessary. I mean, think about it. In the last couple decades, we've watched the market drop to half its value twice now. After 9/11, 2000 through 2002, we saw it drop to half its value. In 2008, with the credit crash, we saw the market drop to half its value. This time it only took 15 months to drop to half its value. Markets are volatile, and when they decide they're going to go negative, sometimes they can go with a vengeance. The other challenge we find today is we're now in a rising interest rate market. If you go back to the 10-year Treasury in 1980, it was just under 16%. Fast forward to about a year and a half ago in July, it hit a historic low of 1.36%. So for almost 40 years, we've been in a declining interest rate market, which was great for bonds. But now, in a rising interest rate market, that can put some downward pressure on bonds. Think about it. If I have a bond today paying me 4%, or let's say 3%, and tomorrow I can get one paying 4%, who wants my bond paying 3%? And they will adjust the value of that bond fund to make up the difference in the lost interest. And if it had a maturity date of maybe 5-6 years, now that's a 5-6% discount to that fund. So these are new challenges. Another new challenge out there is debt. You know, our GDP is 20 trillion, but we've got a national debt of 22 trillion, we've got corporate debt of 14 trillion, and now we have personal debt of 13 trillion. folks, all this has got to be paid back. And I dare say there's most likely going to be a reckoning. So now's the time to pay attention. We have new challenges facing us. If you're not somebody that wants to watch your account drop at half its value, then I'm going to encourage you, again, give us a call. It's no obligation. We have offices, again, all over northern Michigan, Petoskey, Gaylord, Traverse City, Cadillac. We'd be more than happy to meet with you to look at your portfolio and see how much risk you're taking, see if active management is an option. Thank you.
You know, Larry, I really appreciate that segment you did, because I think it's really important for those of you that are listening out there to kind of just think through some of this stuff. We've been now in this bull run for 10, 11 years. Things have been really positive, and yet we're seeing a continued flood to these passive types of investments. And hey, when the markets are up, that's great, and it was so there. But when can active management be really powerful? Well, if the markets tend to falter, don't you want somebody there to potentially soften that landing, if you will? And if you're near retirement or in retirement, these are things that you have to start thinking about. You know, if back in 08, maybe that was, what now, 11 years ago, right? You were 11, 12, 13 years away from retirement, let's say. At that point, you had time on your side. You know, you had another 10, 15 years to work, but guess what? Now we're here. Nobody knows exactly where the market's going to go from here, but you want to start preparing yourself when you do that. Jack, we see so many people come in the office, you know, and as we offer that free second opinion, which we encourage you to take advantage of. But talk about a little bit of what you're seeing right now and what your experiences have been with that.
Yeah, no, I appreciate that education of reminding us of what happened during those down markets, because I wasn't on this side of the aisle yet. But as I get into these portfolios and I start seeing how they're structured, you see a lot. Heavy mutual funds. I've seen variable annuities that have the same mutual fund holdings in them. So people come in, they're carrying different pieces of information of what they might understand, but it's not the complete picture. And so there's some misconceptions about them thinking they're diversified when really ultimately they're not.
Yeah, Jack, I got involved in financial services in the late 90s. We had just been in the, the 80s and 90s had an unprecedented 2 decades of growth, right? I mean, it had some corrections in there, but for the most part, it was going straight up. And I thought, boy, this would be really exciting to get into this kind of business, you know. So I dive in, and I was trained on what's called modern portfolio theory, which is, have a well-diversified, group of assets and have a good mix of bonds, depending on how old you were, maybe more bonds as you got older. And it was through this mass diversification that it was supposed to soften the landing when we had down markets. But then I get hit with 9/11, 2000 through 2002, markets dropping to half its value. And I'm scratching my head trying to figure out what is wrong with this picture, right? And then no sooner came back by 2007, all right, and then we get hit with the credit crash of 2008. Now I've watched it again drop to half its value, and now I'm really questioning, where is modern portfolio theory working here, right? And the truth is, it's not working in times like that. If you're, it's this systematic risk I was talking about in the first segment. Having 1,000 stocks isn't necessarily going to soften the blow, because the market tends to all move in unison. So anyway, in the next segment, Mike is going to be talking about pension buyouts and what we might want to pay attention to when we're looking at somebody who's been offered a chance to take a lump sum or take an annuity payout.
We look forward to helping you plan to retire well.
We are going to talk about pension buyouts. Now, Here's the thing, this might be something you've never heard of before, and it may or might not affect you at some point in your life. But here's the deal with pension buyouts. They're becoming a very big deal. See, here's what's happening. Let's say you worked for a company all your life, and as part of your compensation, you were given a pension. And let's imagine that here you go, you're getting ready to retire, or maybe you're already retired, and you're going to get, or you will receive, a pension of $2,000 a month or $24,000 a year for the rest of your life. In fact, you might even have one of these deals where if you're married, when you die, a certain percentage of that may continue to your surviving spouse, maybe 50% or 75%, maybe all of it. So a traditional pension, what we're talking about here, it's kind of like Social Security. You get income for as long as you live, and when you die, there's nothing left. That's it, nothing left, all done. Now here's the deal. Companies who provide these pensions are essentially on the hook. They have the liability to pay you that $2,000 a month, $24,000 a year for as long as you live. When you're working, that's fine by them, because when you're working, they're not paying any money out. They're just setting money aside. The money's growing. Maybe they're collecting some fees on that money. But when you're retired, they have to pay that for your lifetime. It's their obligation to you. And what's happening today with investing in the markets? 20 years ago, we could go out and get a 10-year government bond paying 6.5%. What's that same 10-year government bond paying these companies today? More like 1.5%. So if you are the company and you are obligated to pay all this out, you're saying to yourself, wait a minute, you're running the numbers and you're saying, man, I don't like this. I don't want that liability. I'm not making any money on this. All I have is a liability. I want to get out of this deal. I want to buy these retirees out. I don't want to do this anymore. That's what the companies are saying. So what are they doing? They're coming to people just like you and they're saying, you know what? Let's do this Monty Hall thing. Let's make a deal, right? That's what they say. Let's make a deal. Here's what we want to do. We want to do a pension buyout program. Here's what we'd like to do with you, Mr. or Mrs. Retiree. We are currently obligated to pay you $24,000 a year for as long as you live. But when you die, there isn't going to be any money left over. How about we do something like this? How about we give you a lump sum and we don't have to give you any more money? So it's always dependent on how old you are. There's all these crazy calculations, but let's imagine that you're, I don't know, let's say you're 70 years old. And they come to you and they say, tell you what, here's what we'll do. We're going to give you a lump sum of $300,000. And what they do is they put it into an IRA in your name. That's how it works. We will deposit into an IRA in your name $300,000, and in return, we don't have to pay you that money anymore. We're all done. We'll go our separate ways. You invest this to do whatever you want with it. We go away. What do you think? Should you take that deal? Should you take that deal? Folks, I got to tell you something. This is probably the hardest question you would ever be asked, financially speaking, in your lifetime. This is one of the hardest things, because you know what? Here's what you're thinking. You're thinking, of course I'll take that deal. I can take that money, I can invest it, I can just take out $24,000 a year. That's not that much. I'll probably have money left over for my kids. But wait a minute. In this particular example, I look at this, I say, well, wait a minute. That is 8%. That's an 8% income stream. Can you make that last for your lifetime? I sure as heck would be a little worried about that. What if you live to your 90, 95? You might be out of money. Folks, this is a very tough decision. If you are facing a decision like this, or you have questions about anything else we talk about in the show, by all means, pick up the phone, give us a call. We'd love to talk to you and help you with decisions just like these.
Today's retirement challenges can be mastered. Knowledge is power because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, financial advisors, specializing in retirement planning, serving all of northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn highlights of the new Tax Reform Act, the difference between the fiduciary and suitability standard of care, how an IRA gets taxed to a surviving spouse, how two similar portfolios can end up with two drastically different results, what a bull market is and how long it can last, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Wednesday, September 18th or Thursday, September 26th at Boone's Long Lake Inn in Traverse City. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated financial decisions. Call 888-608-5825 today.
You know, that's a really interesting segment Mike talked about there. You know, it's so easy sometimes to forget about pensions because we don't see them so much anymore. You know, it used to be when people come in the office, everybody had a pension, Social Security, and some savings. With pensions being less and less offered anymore, they just get more rare. But it's really interesting for those folks out there that maybe are opposed with this decision. Oftentimes, when you're getting to a point, the company may offer a buyout, whether it's because a company transitioned, maybe they got sold, maybe it's you're heading into retirement, whatever reason that may be, and it's something really to look at. You know, Mike talked a lot about a lot of the reasons, but also what about the company itself? You know, we've seen big companies that we would have never thought fail. You know, we would have never guessed that went underneath. And what happened to some of those pensions? Well, maybe they had a pension fund that protected it. Other ones, you know, you see struggles. Even we see municipalities where they're underfunded and stuff like that. You know, there's always this concern that has to be raised is what does that pension look like? How is it funded? And then what is the kind of the credit qualityness of that underlying company? You know, auto industry, for an example. You know, I don't know who's going to be around 20 years from now, but there's so many changes going on. What does that look like? You know, I'm not assuming or not trying to say that they may not be, but just some of the things we have to start looking at.
And another couple questions I think people should look into for analysis-wise is what option is best for me? Is a buyout lump sum from this pension better, or is taking the payout you know, for the pension good?
Right, and what if their life expectancy is short? You know, what if they got poor health? You know, a long-term guaranteed payout doesn't mean anything to them. They just soon have the lump sum, right? So they can pass it on. So yeah, there's so many considerations in this, but something that you'd want to take to an advisor to look at. Many times we'll look at this annuity payout and say if the credit qualityness of the company is good and they've got good health, going to live a long time, and there's good survivor benefits associated with it, then absolutely that may be the best strategy. But sometimes it could be just the opposite. All the more reason you want to, if you have that kind of scenario, you might want to talk to us. So again, thank you for joining us today. Look for us next week.